Hey, what's up, subscribers? Welcome back to my world of stocks, and welcome back to our three stocks on sale series for the month of September 2025, where in each episode, I give you three new stocks that I feel look very attractive at today's prices for the long term. And to make things a little more interesting, I specifically choose one lower risk, one medium risk, and one higher risk option for some added variety. As always, though, please be sure to do your own research, make your own decisions. These are stocks that have been falling by big amounts that I think look very attractive, but again, they do carry some risks. So make sure you keep that in mind. But starting here off with what I consider to be at least the lowest risk of the bunch, we're going to start with that one first. And this month, I'm going with what is at the moment my overall favorite dividend REIT in the entire market right now, and that is Extra Space Storage, ticker symbol EXR. As this is one really that I would say it usually goes back and forth with like Vici Properties, another favorite dividend REIT of mine. But as of right now, EXR is the one that is looking more attractive to me on the current price, given that it's not only one of the few stocks really out there that is actually negative this year, but from their highs, it's also lost close to 40% of its entire value, which is a huge crash for such an incredibly strong and resilient company that I really feel very strongly that I can actually rely on them long term to not only generate strong capital appreciation, but also to pay out some mouth-watering dividends. That's because self-storage as a market is itself one of the most resilient in the world. In fact, storage REITs have actually generated the second highest returns of any REIT class in the past 2 decades, being only behind data centers, which we know is almost impossible to beat right now because of the rise in artificial intelligence. But you look at any other REIT class, really, like housing, malls, healthcare, and more, self-storage beats them all. And it's in large part because demand for storage units is always high regardless of the macro environment, with the percentage of US households using them only ever going up year after year, even through the Great Recession, the 2020 pandemic, and even right now, with all the current issues that we have of high inflation, interest rates, tariffs, and more, it's actually hit a record high in the double digits. On top of that, storage facilities typically require much less maintenance and minimal on-site staff compared to other forms of real estate. Thus, they tend to generate more reliable cash flows on higher margins, allowing them to not only get through difficult times, but also pay consistent and growing dividends every year too. And within this very attractive market, I just think EXR really stands out as the best choice among them. Not only the most market share, but also some of the strongest occupancy rates, well above 90%, as well as more revenue growth than their peers, more funds from operations, a stronger balance sheet, big acquisitions and expansions made every year. And because of the stock dip, the dividend yield has also risen to above 4.5%, which is among the highest levels that we've ever seen from them. In fact, most of the time, we'd see that yield much lower, even half of where it is today. But because of our high interest rate environment, the stock price is being unusually suppressed at these lower levels, resulting in a larger than usual dividend yield. But personally, I don't see this continuing for very long into the future. I actually think interest rates will eventually be coming down here. And once that happens, I expect investors to start pouring back into the stock, driving the price up, but also causing the dividend yield to correct back down to where it would normally sit. Now, nothing's a guarantee, of course, but these are some of the reasons why I'm buying the stock myself at these levels while I still can. All right, for stock number 2, though, I'm actually going to go with an even bigger dividend payer here, with the trade-off being that it is a little higher risk too. But that stock is the biotech Bristol Myers Squibb, ticker symbol BMY, who, like EXR, has also seen a big drop off in price, not only falling by over 40% from their highs, but they're also trading at one of the lowest levels of the past decade. And the result is, again, very similar to EXR, is that the dividend has now risen to one of the highest levels we've ever seen from them at more than a 5% yield, which is way higher than practically all the other years that you could have owned this stock. Unlike EXR, though, who I feel is trading low more so because of macro issues, Bristol Bristol's issues, I should say, are instead much more internalized, specifically in the face of one of the steepest patent protection cliffs within the entire industry, with several key drugs either having already lost protection or expected to lose it by 2028, like is the case with their best-selling blood thinner and cancer medications, Eliquis and Opdivo, respectively, which made up the number 2 and number 4 top drugs to lose patent protection over the next 5 years, according to Pro Clinical Research. And as such, despite generating record-breaking sales last year, analysts are actually expecting there to be declines in each of the next 3 years going forward for Bristol Myers revenue. On top of which, profits from earnings per share crashed last year, even turning negative by a large amount too, causing investors to panic and sell out of the stock now. But the contrarian in me really decided to buy the stock regardless, and it's for one specific reason, I would say, and that being that pharmaceutical companies, especially the strongest among them, tend to always go through these fairly predictable waves of cyclicality where certain drugs take off, they generate mind-blowing profits, the stock price soars accordingly, and then those drugs lose patent protection, the growth slows down, and investors start to panic and sell out of the stock, only for the company to, I should say again, the stronger ones, to later develop new treatments, advance drugs through their pipeline, and even make strategic acquisitions to restart their growth engine and repeat the entire process all over again. In other words, at least in my opinion, large and well-established biotechs like Bristol or even Merck, Pfizer, AbbVie, and more are best purchased during these actual downturns when the price is at the lowest levels, not when it's at the peak. And so when I see Bristol trading at what looks to me like very clear support levels for both the stock price and the dividend, well, I just feel like it's worth buying in to ride that wave of recovery back up in the future, which we know that Bristol is already working on all those growth drivers too. In fact, that EPS plummet of last year was actually due to one-time charges from a massive $14 billion acquisition of Karuna Pharmaceuticals, hence why their EPS is now expected to recover to new record highs this year too, leading to incredibly cheap forward PE and PEG ratios that are 50 to 90% lower than the sector median, and also being fueled by the Mirati Therapeutics acquisition, the one in RayzeBio, the new indications for some of their legacy drugs, their new growth portfolio that is also higher margin, and the rest of their already very large pipeline of future treatments that they'll look to tap into long term as well. The point being to really take on this short-term pain now and lock in these low prices with a huge dividend so that I can later benefit from it all in the future. All right, guys, it's time now to finish up though with the third and final stock, what I consider to be the highest risk of the entire bunch. And this month, I'm actually going with a pick here that I don't think I've ever even covered before on the channel. So very interesting one here. You're going to want to take a look at it too. But the more that this stock actually gets dragged down, the more that I'm getting tempted to buy in myself. And that is The Trade Desk, ticker symbol TTD, which if you've never heard of them, this was once the crown jewel of digital advertising and one of the hottest stocks in the market for that exposure, which I'll show you in just a second. But they really rose to fame operating a cloud-based demand-side platform, or what we call DSP, that allows different brands and ad agencies to buy digital ad space across the internet in real time. So think of it like Wall Street for ads, where you basically are going to be bidding on impressions, targeting specific users with hopefully surgical precision, and optimizing ad campaigns across websites, mobile apps, TV, video streaming, even audio, and more. And so as the world became more digitalized, especially during the pandemic years, well, advertisers really rushed over to platforms like The Trade Desk to reach more consumers online. And that sent demand for both their business and the stock soaring to new record highs. Revenues, for example, grew by over 20% in 2020, 40% in 2021, another 30% in 2022, and still over 20% in each of the past 2 years. But as you can see, analysts are now expecting a drop off down to less than 20% growth in each of the next 2 years. Part of the reason why is because, unlike Google or Meta, for example, Trade doesn't actually own the media that gets advertised on. Instead, they just supply the tools and the data required by advertisers to make smarter purchases with more transparency and control, which again is very useful and in high demand. But what it also leads to, unfortunately, is what analysts call a walled garden. It refers to a closed ecosystem where a company like Google, Meta, Amazon, or Apple really hold all the power, in that they can control both the data and the ad inventory. And so if they decide not to share that data with outside parties like the Trade Desk, either because of user privacy or maybe more conspiratorially, they may want to make that money themselves by offering competing services. Well, it ends up making the Trade Desk's job much harder. Now, Trade is addressing these concerns with new technologies, like, for example, their Unified ID 2.0 service that carries more privacy conscious features, and it aims to sort of replace third-party cookies long term while giving advertisers better targeting across the open web. Or by focusing on other areas for growth like connected TV, where walled gardens are less dominant and premium ad inventory is much more accessible. Or even just by forming new partnership deals with publishers and data providers too, to minimize the impact as much as possible. They're also even looking to expand internationally, where it may be a little more open season for a company like Trade Desk to be operating in. But look, the thing is that when you couple the slowing growth with these other issues, which are very real concerns, hence why I consider this a high risk stock, well, the result has been that for what really used to be a skyrocketing stock price, it's now been collapsing. It's actually crashed by more than 60% of its value from the top. To be clear, now it is still technically up over 1,000% in the past decade, but for what used to be one of the richest, most expensive growth stocks in the market, actually now trades about the same PEG ratio as the sector, thanks to not just the fall in price, but also the strong growth, with sales still breaking new record highs every year, while their EPS profits are expected to more than double this year, in large part because of big artificial intelligence integrations that are not only helping them run leaner, but are also improving their products and services, and thus raising demand and helping them sustain high growth. All of this to say that while the stock is, again, pretty high risk, it may also be high reward on this dip, which we can see reflected in analyst price targets. Out of the 34 analysts covering the stock, they hold an average price estimate that is about 70% higher than where it trades today. Now, some analysts do expect an even further decline on the price, again, reflecting those conflicting feelings on the stock. But while I don't own it myself yet, my gut tells me that almost all of the bad news here is pretty much already priced into the stock, leaving what looks to me like more and more of your typical kind of tech growth stock is actually starting to trade at a pretty good value too, especially when you look at that PEG ratio again. So I may want to dip my toes in this stock myself soon too. Anyway, that's going to do it for this month's video. I hope you guys enjoyed it. Let me know what you think about all these stocks down below in the comments section. And if there's any stocks that you guys are buying, let me know that too, so I can include them in future videos if you'd like me to do my own research on analysis on them and make a video for you. But hey, either way, hope you're all doing well, my friends. And I will catch you in the next video. All right, take care, everybody. Bye-bye.